Rick, we were talking before about central banks, about the concerns you had about central banks and what they could do and couldn't do. Do you worry that they don't have the tools to deal with the next downturn if the next downturn is actually sooner than expected?
It's a little bit of a concern, but they do have more tools in the toolbox. Certainly the Fed have got a lot of policy scope, and we can see the return of QE. European Central Bank could do a little bit more in terms of less orthodox types of QE. So there is a little bit left, but I think, frankly, they'll need to do something else, and I don't think we can rely on central banks to do it.
Okay, where do you see value in this? Is it emerging markets because of what the Fed is doing? Or if you look at the earnings season, is it Europe because a lot of investors were so downbeat on Europe that expectations are so low?
Well, within the equity market, we're overweight US, but we're underweight pretty much everything else. We've backed off from emerging markets, but because we were concerned that the stimulus efforts of China really weren't paying off as much as we thought. Right. So we backed off them, we backed off Japan, earnings revisions. Earnings this year have been very weak. But we're left long of the US.
So your take is basically if China's stimulating inwards, then a lot of that money doesn't go to some of their exporting countries?
Well, it's really that China is the epicenter of many emerging market stories, whether it's technology or commodities. And if China's not strengthening back up, then we've got problems in emerging markets. And I think you've got an investment sentiment challenge as well for emerging markets.
Rick Lacaille, when I link in investment into central bank action, should investors be allocating or reallocating or being stable based on what these central bankers are going to do? Do we look at them from a distance, or are they really part of our investment decision right now?
You can't ignore central banks, but the central issue, certainly for equity investors, is where are earnings going to come from? Because I think the discount rate matters, to be sure, and if you get a shock in central bank policy, that's going to affect all markets. But investors really need to focus on earnings and where they're coming from. And I think the earnings story has weakened. It's not terrible, and it's probably a little bit better in the US than people had thought. But that's really the focus of investors for equities.
Where are you reallocating to now? Where is the sector that State Street finds the best opportunity, either defensive or cautious or actually to be opportunistic?
Well, I think for sectors, I think people have underestimated the potential for US financials. The capital ratios are very strong. I think people have overestimated the damage the yield curve could cause. And the US economy is still growing quite nicely. Outside of their area, I think some of the growth sectors like tech in Europe, healthcare globally, real estate, certainly outside the UK, real estate looks an interesting value opportunity, a very strong income-producing asset as well. So I think there's a very interesting diversified sector portfolio you can put together if you're willing to take a little bit of risk.
Rick, what would it take you to go back onto emerging markets? A stronger China?
Well, obviously, a resolution to the trade dispute followed by better business sentiment in China, which means you wouldn't need so much of a stimulus effort. So I think it all stems from this, lack of trade certainty. I think when that's over, you'll see a big change.
But can it be over for good? If we have a trade deal in a couple of months, what tells you that, the U.S. or China won't pick a new fight in 3 months from that?
Well, I think it's over for Chapter 1, but there are other things unfolding, whether it's technology or security issues, that I think will be a continuing noise issue in the background. But the big picture issue of trade, Chapter 1 will resolve a lot of uncertainties for investors.